The Wyckoff method is interesting because it is essentially an indicator-free approach that allows one to determine which side has the advantage, demand or supply, based on the behavior of price dynamics and accompanying trading volumes, even during the accumulation or distribution of positions. The foundation of Wyckoff's method is based on three laws. The first one is the law of supply and demand. If demand exceeds supply, price will rise. If supply exceeds demand, price will fall. If there is a relative parity, we will not see significant price changes, and volatility may even decrease. The law of supply and demand is the cornerstone. It's not just something you cannot underestimate. It is your paradigm for perceiving the market. If, for example, you base your analysis on the idea of an unknown market manipulator who is often imagined as a single entity deciding whether the market will go up or down, you will struggle to master this method. This is also an element in Wyckoff's framework where one might make mistakes in interpretation. We will certainly discuss this. The second is a law of cause and effect. Accumulation is a cause and it leads to an upward trend or price increase, which is effect. Conversely, distribution leads to a price decline. We will explore how to timely identify these causes. For this, Wyckoff kindly provided specific schematics. What deserves emphasis in this law is that if the cause is weak or insignificant, the effect will be correspondingly weak. In other words, the second law refers to the potential of price movement. For example, you might spend countless hours staring at candlestick charts, trying to identify a Wyckoff reversal, determine the accumulation phase based on specific patterns, but end up taking profits that don't align with the actual potential of the move. Conversely, you might identify a distribution phase but expect the price to crash by 90% due to your bearish bias, short position, or lack of faith in the asset. But Wyckoff's second law reminds us, the magnitude of the effect, price decline, depends on the cause, distribution phase. If the cause is weak or insignificant, why would we expect a catastrophic outcome for the asset? Now, the third law, the law of effort versus result. In my opinion, one of the keys to understanding volume spread analysis. In fact, this law is the foundation of the Wyckoff method itself. Let me add a quick note here. To my surprise, many who claim to trade using Wyckoff mistakenly believe it's all about more buyers in a range equals uptrend or more sellers in a range equals downtrend. This is nonsense, and this video will explain why. Wyckoff emphasized the third law not because of who bought or sold more, but because of the relationship between volume, effort, and the price movement result. This is a fundamental shift in market perception, not a minor detail. For example, if prices are rising with increasing or sustained volume, this supports the continuation of the uptrend. If prices are rising but volume is declining, a reversal is likely. Everyone wants to sell high, but fewer buyers are willing to chase higher prices, hence a potential drop. If prices have been falling and then suddenly a large spike in volume occurs without further downside, this signals accumulation and likely reversal upward. In short, the third law teaches us to analyze whether the effort volume aligns with the result price action. Mismatches often foreshadow reversals or warn of weak trends. If you didn't grasp that in the first and second examples, we primarily followed the logic of the first law of supply and demand, while in the third example we applied the law of three efforts and result. In the third example, the market exerted significant effort, but for some reason achieved only minimal results. Since the trend had been downward all this time, meaning prices were falling, everything was, let's say, within normal bound. We were steadily moving in the intended direction. Then something happened, and the price could no longer continue moving in the same direction. More effort was made to maintain the usual course of events, but nothing. A bit more fuel was burned, still nothing. We're practically stuck in place. It turns out that for some reason our efforts are not yielding corresponding results. In this example, that reason is demand. These examples I literally demonstrated within a few candlesticks, but this logic applies equally to prolonged and tedious consolidations. However, Wyckoff employed this approach in his explanations and called it the composite man. Essentially, he proposed viewing the market as if it's controlled by a single entity, not one who definitely knows where the price is going next, but a composite man, meaning a collective entity. This composite man is made up of various components: institutional market participants, investors, market makers, and others. All of them are driven by a simple desire, their own self-interest to buy low and sell high. In other words, there are many players, but they act as one, making it easier for us to perceive and interpret the market. Ultimately, the cycle that the composite man will go through to achieve his goals consists of 4 phases. The first phase is accumulation. To sell something, you first need to buy it. The second phase is the direct impulse, a price surge or trend. In other words, the first phase was the cause and the second phase is the effect. The third phase is distribution, selling everything that was accumulated earlier, meaning the composite man's goal is fulfilled. And the fourth phase is the decline or correction, a downward trend, since in the third phase we had the cause, distribution, leading to the corresponding effect. In the second phase, we might see reaccumulations, repeated accumulation phases that are likely less significant. The upward trend simply attracts additional market participants, as everyone wants to join the rally in the direction of the trend. Similarly, in the fourth phase, we can see redistributions, analogous to reaccumulations. You might wonder, what to do when things aren't as straightforward as I've illustrated here? This is where Wyckoff's third law of effort and result comes into play. Only now it's applied not to a few candlesticks, but to evaluating these consolidations. Additionally, Wyckoff advised paying attention to the character of a specific asset. For example, if you take XRP, it behaves differently compared to, say, Ethereum. When Ethereum rises, it does so in a more humanly understandable way, unlike XRP, which constantly does something out of the ordinary, even though the charts here are from the same period. It's also crucial to consider the overall market sentiment. If everything is surging upward, the likelihood that a consolidation is actually distribution becomes far lower. Overall, you can gauge the strength of a specific asset relative to the market. In the case of the crypto market, we can look at how a chosen asset performs against Bitcoin. If it shows strength, the likelihood that consolidation phase turns out to be distribution decreases. And let's wrap up with what everyone starts with: the schemas of accumulation and distribution. From what I understand, many believe that the grail lies precisely in these schemas. But in my opinion, and according to unverified data, 70% of the grail resides in what I've already described earlier, while the schemas are a nice bonus in the form of patterns that complement the method. The less immersed you are in the logic of this method, the more your approach should align with Wyckoff's proposed schemas. As I mentioned, I've omitted much of Wyckoff's work, and after a long time it turns out that my approach overlaps with his logic by at least 50%. Of course I prefer my own, but it's nice to realize you've been reinventing the wheel all along. Now, Wyckoff's trading schemas. Let's break down the accumulation schema into 5 phases: A, B, C, D, and E. Phase A is the downward price movement, ideally with deceleration, meaning each subsequent downward thrust becomes smaller and smaller, but trading volumes conversely should increase. During this time, preliminary support forms. Next comes the selling climax. In other words, within an already downward trend, the price starts falling so rapidly that it forces market participants holding the asset to capitulate and sell. Some also attribute this to sellers aggressively jumping into the last train. But in reality, both buying and selling occurs during the climax. This is a moment of exceptionally high volatility, where we see long wicks, wide spreads, and all the hallmarks of panic, or signs of it. Since panic selling causes price to plummet so swiftly, it doesn't encourage the placement of tight limit sell orders, but rather triggers market orders. This leads to an automatic rally. Since there is a second party, those who were buying throughout this selling pressure, we see traces of their activity on the chart. This establishes a specific trading range between the low, marked by a selling climax point, and the high, set by the automatic rally. After the AR point forms, decline follows. At this point, the market is still in a downtrend, leading to a secondary test. Through the secondary test, we can identify signs of demand and the willingness to buy the asset at price levels established during the climax. With this, Phase A is considered complete. Phase B. During Phase B, consolidation occurs, or what Wyckoff terms the cause, where the actual main accumulation takes place. Remember, we're analyzing the composite man's positional buildup. At this stage, the price may repeatedly test the support or resistance levels, defined earlier by the trading range. Here, multiple secondary tests are common. In the support zone, limit buy orders are already staked, while in the resistance zone, we might see false breakouts or bull traps. In this case, the price breaks through the resistance level, but later falls back into the trading range. If such a false breakout appears in a specific way, you can identify it as a fake in advance. For example, if the breakout looks like an upthrust, a so-called leap of faith, characterized by a long wick, a close near the candle's opening price and high trading volume. This signals that selling pressure is intensifying. You might ask, why? After all, the composite man is accumulating positions, which should logically drive prices up. The answer is simple. The position hasn't been fully built yet. To push the price back into the range, the composite man himself might apply a downward pressure. However, it's crucial to emphasize that we need the price to actually return to the range to confirm the false breakout. Guessing beforehand isn't advisable. What else defines the accumulation phase? Rallies tend to occur with wide candle spreads or sharp impulses. This is linked to market buying, while declines drift toward the support zone more sluggishly. Phase C. This is an interesting phase, sometimes called the spring period, which forms a false breakout below the support zone. Essentially, it's another false breakout, allowing positions to be filled faster by exploiting additional selling pressure at this precise moment. Afterward, we get an impulse, like rebound from the demand zone. Phase D. Here, we see the beginning of the effect's realization. The post-spring impulse, ideally accompanied by the high trading volume. Roughly speaking, a confident uptrend forms, marked by higher highs but not lower lows. Near the key resistance zone and last point of support forms, a consolidation before the final surge, often marked by a sign of strength, a strong bullish candle with a robust volume. Phase E. This is the exit from the trading range and the start of the uptrend, the direct effect phase following the cause. Here, the price clearly exits the accumulation phase and enters phase 2. The distribution schema is a mirror image of the accumulation schema, so we won't dwell on it as long. The differences lie in the renamed key points Wyckoff highlighted. For example, support becomes resistance or supply in the abbreviations. Schematically, it looks roughly the same. But the critical element isn't the pattern itself, of course, but its underlying logic. Let's focus more on examples here, without over-perfecting the pattern. Let's just grab a chart and crudely map out something that fits the description during practice. In fact, I'll use the same descriptions that characterize the accumulation zone, without altering the core logic. I think you will grasp the idea. So please don't nitpick about me not using the correct abbreviations. Alright, we see a price rise and suddenly there is a spike in volume. What could act as preliminary resistance? Let's mark that event. Next, we should see a subsequent rally, which ideally ends in a buying climax. At least on the daily time frame, we don't see a clear climax, but there is something resembling an automatic decline, where we don't observe significant demand to hold on the price via limit orders. After the automatic rally comes the secondary test, where false breakouts might also appear, and we see this secondary test. You could call it a spring, though remember that distribution phases use different terms, but let's stick with spring for now. If you want to study this in detail, pause and try to memorize what I've sketched on the slide. I'm following rough logic here. After the hypothetical spring, there should be a last point of resistance, which I described earlier as a consolidation before breaking through major resistance. But here, it's support, since we're in distribution. There is something vaguely resembling this, and at this point, the cause can be considered formed. Once a clear breakout happens, the effect plays out. To sum up, we have a hypothetical phase A, where we marked preliminary support, phase B, where the price moved back and forth within the range, phase C, which we'll call a bull trap or spring, phase D, where we see a decline with signs of strength, aggressive candles followed by sluggish pullbacks, and finally phase E, where we see the breakout. Even with this large distribution, if we dissect consolidation zones, we can spot similar patterns. The decline ends with a climax, followed by an automatic rally, phase B, a spring, a last point of support, and finally the exit from consolidation. If you enjoyed this, hit like and subscribe. If you want to learn my personal strategies with proven edge that I've developed myself, feel free to check them out by the link in the description. They are completely free, rule-based strategies that even beginner will understand. Good luck with your trades, and see you later.